This video is sponsored by Ground News. For years, America has been the number one. Economy? Yup. Military? Absolutely. And culture? Pretty much everywhere. The US has dominated in almost every field. Well, except for living standards, and the happiness index, and what about gun-related deaths? But anyway, barring those statistics and quite a few more, there's one area where the US has really, genuinely dominated. The stock market. The S&P 500 and Nasdaq have almost always had the best returns and have been the envy of the world since 2008. But that dominance is starting to wobble, and not just a little bit. Look at the returns since the start of the year. The S&P 500, which tracks the 500 biggest US companies, is basically flat, hovering at around an unimpressive 1%. The Nasdaq is doing even worse, sitting at roughly minus 1%. Now, compare that to Europe, and we're doing a lot better. The Euro Stoxx 600, which tracks large and mid-sized companies across the EU, is up around 6%, and that's a significant gap. And this chart makes it even clearer, as it shows investment funds flowing out of US equities and into European ones at pretty much record levels. And so far, there's really no sign of this trend slowing down. So yeah, great stuff, Europe. I obviously love it. But the real question here is, why is this actually happening? And more importantly, can we sustain it? And we see three main reasons. And the reason one is that the US is suddenly feeling unstable. I mean, put yourself into the shoes of a big investor for a second. You care about one thing only: predictability. And right now, the US is not exactly screaming stable long-term investment destination. And that's because of one man. And you guessed it, Donald Trump. I mean, when investors wake up to headlines about the US threatening tariffs on allies, flirting with blowing up NATO, or casually floating ideas like, what if we just take Greenland? That's just not good for predictability, and markets hate that. And remember, Trump has around 3 years left, which means everything right now feels temporary. Policies can flip overnight. Rules can change with a single tweet. And that's not a great environment if you're parking billions of dollars. Then there's also the valuation risk. US stocks, especially tech, are so expensive. A lot of the US market is now riding on AI hype, and some are calling it a bubble. Maybe it will pop, maybe it won't. But if you're an investor, you don't want all your money riding on the, hey, trust me bro, the AI revolution is coming. So what do? You diversify. And Europe suddenly looks quite reasonable. And finally, we have the dollar. The US dollar has been weakening, while the euro has been holding up better than many expected. And if the dollar keeps losing value, US assets become a worse store of value for global investors. So, from an investor point of view, the calculation starts to look like this. Political stability? No. Geopolitical stability? No. Fair stock market valuation and no AI bubble? Definitely not. A strengthening currency? No again. And these are bad indicators for an investment location. And they're bad for growth too, because all of this shows up in the real economy. In fact, US growth has slowed sharply in the fourth quarter of 2025, coming in well below expectations. And this wasn't some niche data point. Over 200 news outlets covered the story, across the entire political spectrum. But, as I'm sure you can imagine, there were very different explanations for why this slowdown actually happened. And this is where one of the biggest problems in news consumption shows up: bias. And this is exactly why I use Ground News. If we look at their bias comparison tool, which is awesome by the way, we can see that left-leaning outlets overwhelmingly focus on one explanation: tariffs. Meanwhile, right-leaning media outlets largely avoid tariffs altogether, instead focusing on the government shutdown, often blaming Democrats for the slowdown in the economy. And that bias isn't coming from politicians, it's actually coming from news outlets themselves. And that's where Ground News becomes genuinely useful. You can also check individual news sources when you scroll down the page. And Ground News clearly shows the political leaning, the accuracy of the article, and the owner. Great tools to give you the context you need when you're reading. If you want to try it out yourself, you can get 40% of the Ground News Vantage plan using the link in the description or the QR code on the screen right now. Now, back to the video. And this brings us to the second reason why Europe is suddenly winning. It's the polar opposite of the US. I mean, you know the EU. It's slow, painfully slow, but it's also predictable and stable. In Brussels, decisions are negotiated, watered down, and reviewed for 3 years before they see the light of day. That sounds like a nightmare, until you're a CEO trying to greenlight a €5 billion factory. And there's pretty much zero chance that Ursula von der Leyen wakes up one morning and nukes your supply chain with a random 40% tariff because she had a thought. But of course, it doesn't mean that Europe does not have baggage, especially geopolitically, with a hostile Russia to the east. But notice how Europe handles it differently than the US. They don't really threaten to burn down the house. They lean into the existing institutions. The EU, NATO, WTO, and so on. And aside from the occasional headache from Hungary, the EU bloc is actually acting with a level of unity we haven't seen in a long time. Next up, let's have a look at stock valuations. If you look at stock prices in Europe and the US before 2008, they were pretty similar. It's only after 2008 that this massive gap opened up. European stocks were pretty much unloved for many, many years. And that gap could be where a lot of the future wealth generation comes from. And then there's the biggest reason of all, reason 3, Europe's potential. You know, this is a market of 450 million people, bigger than the US, and for years it has been underperforming. Overall Eurozone growth is still modest, around 1.3%. But look closer and you see clear outliers, Spain, Portugal, and especially Poland and Ireland, who are absolutely flying. Strong growth means strong confidence, which can lead to strong investment. Even the heavyweight underperformer, Germany, is finally being forced to wake up. We're seeing massive generation-defining spending plans of 1 trillion euros on defense, energy, and infrastructure. And when Germany spends, Europe feels it. But the real alpha is in what hasn't happened yet, unlocking the single market. Right now, the EU still has huge self-imposed barriers. Goods face the equivalent of a 44% tariff, services over 100%. And capital still does not move freely. We've made an entire series of videos explaining how insane this actually is. Here's what I think. It feels that for years, Europe has been playing in the Europa League, when we clearly belong in the Champions League. And honestly, it's about time we get promoted. And I think this is a massive opportunity because the foundations are already there. US instability on the one hand, and EU stability on the other. But what I would really like to see is us turbocharging this opportunity. And we can do this with the Savings and Investment Union. Europe has enormous savings, but far too much of that money just sits idle underneath the bed mattress or flows abroad. And we need to turn European savings into fuel for European growth. But second, and potentially even more important, we need to do something even more ambitious. Eurobonds, a truly integrated EU debt market able to absorb global demand for euros, would create a powerful, self-reinforcing cycle for investment and for growth. And contrary to what many people actually think, everyone wins here. Small member states get access to funding for low interest rates for large, high-return projects. And yes, we have to mention Germany here too, because they also benefit, as it's a way for them to finance the investment wave it desperately needs to transition away from only cars to energy, infrastructure, defense, and new high-tech industries, without strangling its own economy. And then, of course, there's France. This is the only realistic path to stabilize its finances without triggering a crisis that drags the entire Eurozone down. So, complete the single market, finish the Savings and Investment Union, and yes, eventually do issue Eurobonds. So, let's get it done. And thank you so much for watching. And if you want to dig deeper into media bias and understand how stories are being framed, check out our sponsor, Ground News. You can get the Unlimited Access Vantage plan with 40% off by using the link in the description or scanning the QR code on the screen. And thank you to our presidents, Kristen, Peter, Clement, Daniel, Dev, Eupedia, Giuseppe, HVD, J. Kiki Luxon, Maciej, Mikael, Rashid, Chao Qian, Stefan, Unite Europe, Martin and Ave Europa, Gant, and Sigimantas. See you in the next video.